thinking about that sort of where digital comes into that, it's still a hugely important factor. And even for human longevity, we all have the digital. Everyone's got their ring or their watch or some tracking device, or they're a membership of something like Fun. Like there's all these trends sort of towards the digital aspect of measuring it. But ultimately, there's just, I think, a real win if you can find a business that hasn't lost that analog human component.
Hey, everybody, and welcome back to another episode of Behind the Franchise. As always, I'm your host, Paul Ehlinger, and today I'm super excited. We've got serial CEO and entrepreneur Christina Russell here to join us. Christina, thanks for being on.
Oh, thank you so much for including me, Paul. It was great connecting with you at the IFA conference a couple weeks ago, so this will be fun.
Absolutely. And shout out to IFA. I mean, we could start there. I thought it was a great conference. I thought it was one of the best ones I'd been to.
Oh yeah, no, they called it Evolve, and I think that they did a
It
really great
evolved.
job of evolving the way that they're actually delivering content.
Hmm.
And I haven't been this. I took a little bit of a sabbatical
Yeah.
with the career transition and the move to more of a consulting and board type role. But I getting back into it was really really impressed with what they're doing.
Yeah, totally agree. And for those who don't know, you've got a very illustrious career within franchising. But maybe if you can give us the cliff notes of your background and kind of what has led to where you are today.
Sure, I'd love to. Yeah, my career sits really kind of at the intersection of franchising, which has been really my sweet spot for the last 25 years.
Yeah.
But that along with consumer services and private equity backed growth. So
Hmm.
most of the work that I've done has been stepping into brands that have had private equity come in as investors. So that includes Camp Bow Wow, Pure Barre, Sola Salon Studios, the Woodhouse Spas. So really the whole, service sector sort of gamut. And I cut my teeth in fitness with
Yeah.
Curves way back in the day when that brand was just getting started.
Yeah, that's awesome. I'm curious, when it came to just understanding the private equity mechanism, what was that for you? Was it just like an initial experience raising private equity to help build one of your brands, or how did you really get deep into that side of things?
Yeah, no, it was at the VP stage of my career. So I was the
Mhm.
VP for operations for Curves when that brand had 6,000 units, if you could
Oh
even
wow.
believe of that. So that brand sort of invented boutique fitness, but boutique business
Yeah.
and grew really quickly. But they got acquired by private equity, and that was really my first experience with it. And what I
Hmm.
found then that is still very true today is what shifts really when private equity comes in is this rigor towards data, 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 data. And
Hmm.
I really enjoyed that coming from a founder-led business where data was still it was important, but it wasn't the mission, the core, which was this mission from God to bring fitness to women, right? But it's an interesting thing when they come in because it really does create some cultural shifts, some for the good and some that can be
Hmm.
pretty challenging for franchisees and for the franchisor.
Yeah, and I think it just really makes a difference as to when private equity even comes into play because I think early on, like data is great, but man, is it hard to maintain or build those data systems that actually matter. And then by the time a private equity is interested, it's like, oh wow, you need robust financial reporting everywhere, robust operational metrics on every aspect of the business. And I think it's something that not a lot of brands are even ready to go through due diligence with a private equity firm because of their data setup. I'm curious, when it comes to that, how are you consulting with brands and saying, hey, this would never pass, never pass review? Like, how are you pushing them forward when it comes to it?
It's an interesting thing. I think you can give private equity some of the credit for this, but I think the
Hmm.
industry has come
Gotten
forward
better.
dramatically from where it
Yeah.
was. I mean, for perspective, when I first started with Curves, this was right at the what the younger folks like to call the turn of the century, so around 2000. And it was interesting because we ran a business that had no computer in it. So
Oh
Curves
wow. So
was
it's all
had
paper-based records.
it was a paper-based record business at the beginning. And so
Wow.
very quickly we ended up getting a very nice system in place. And by the time private equity came in, we did actually have more robust aggregated data, but nothing compared
Sure.
to what I see in brands today. And so most of the brands that I've worked with have already moved that direction. I think still the biggest challenge is getting consistent P&L level data from franchisees,
100%.
but even that you've seen good evolution with. And I think the franchisors have learned from private equity the benefits of that because it
Yeah.
puts the focus where it should be, which is on the unit level P&L.
Yeah, I think it just induces transparency, right? If everybody can see like how operations are actually occurring, then we can actually acknowledge the hard truths. Like some units aren't performing well, and we need to address those. I'm curious what has shifted, for you over the last 25 years between PE and franchising. I think It's undeniable that they're getting more involved. Like you can definitely feel a bigger presence. There's more funds participating. There's more assets being put into place. What have been the biggest shifts that you've seen?
Well, there are a lot of shifts, but I would say that the biggest one is that in the early years of private equity investing, there seemed to be an overemphasis on system growth. And
Interesting.
so you would hear in the CEO groups when we would, have our support calls for one another to talk about,
Hmm.
what are
Hmm.
you experiencing? There was this sort of grow and go mentality that I think
Yeah.
dominated the initial private equity growth, where they
Hmm.
weren't thinking so much the way that a franchisee thinks. So we think of franchisees, they've used their 401k and taken a mortgage on their house and put a personal guarantee on a 10-year lease with two fives after, so
Yep.
it's a different mindset than someone coming in with a 5-year thesis wanting to grow the system to a certain degree and then exit. And I think that has sort of cured itself because private equity has learned that that isn't really how it works in franchising. And I think
Yeah.
there's a stronger understanding that if you do want to grow system growth, you have to grow unit level first. The AUV
Hmm.
is important, but more important is that profitability number. And if
Yeah.
you're very focused on that, it kind of keeps you out of trouble because
Yeah.
the bright shiny object syndrome, all these great ideas you have when you have a large system. I mean, I certainly saw that in Curves, that there were a lot of ideas on how to make money at the franchisor level across 6,000 units just in the
Sure.
US. But if the franchisee isn't interested in those things, they're never going to work. It's sort of like
Sure.
the organism rejects the organ. Like it's
Yep.
not going to happen.
Yeah, and I mean, at least from what I'm seeing, is even a lot of the valuation happening by private equity groups is done on an EBITDA revenue multiple,
Uh-huh.
right? Not just a revenue multiple; it's done on an EBITDA multiple. Um, I think that's can be hard to translate down to the unit level, right? And so, like being able to translate, like, hey, we may not do this program. I get it makes you money, but it doesn't make us money at the end of the day on the bottom line. What have
Yeah.
you been working with brands to help them even just translate, like, hey, this is why we're making some of these management decisions because it's to drive EBITDA. Like, how are you making that clear to franchise systems and their franchisees?
Well, I think that this is where franchising, I think, has benefited in some ways from private equity. They are willing to bring in the capital that oftentimes founders and certainly, emerging brands do
Yeah,
not
don't
have.
have access to. Yeah,
Yeah, and so you think about the way that marketing works today, and it's much more coin operated than it was,
100
20 years
100%.
ago.
Yeah,
And so if you don't have enough coins to put in that machine, no matter how good your
you
branding
can't
is,
even play. You can't
you
play.
can't.
Yeah,
No, and so that is a big piece of it that most of the private equity brands look at now and that the franchisees really appreciate. I think the other piece of it is they look at making those investments in technologies that
hmm,
franchisors often are resistant to because it really is a big capital investment.
yep,
But the way that a franchisee, or I'm sorry, a private equity firm is going to look at this when they come in is they look at their 5-year horizon, and in those early, months and years, they want to make those big investments that are going to drive something that makes the next round of private equity interested in private.
100%. Yep,
Oftentimes it's data systems, it's technologies, it's front end automation that makes it easier for consistency at the front of the house. Or I think about simple things like we had a system back in the day at Camp Bow Wow where we owned our own technology. We were able to implement an innovation to basically ask at the front desk, much like the would you like fries with that question,
yep,
the question about picking up a clean dog.
yeah.
And the ability to do that through a POS really increased the revenue dramatically for
Oh yeah,
franchisees who otherwise their teams just weren't asking the question. So
yeah.
innovations like that, it's not easy for any franchisor to do, but private equity will often see, this is where it's at. But the other cool thing though, and I'm sure you've heard this before too, they're so data driven. And
Yep.
one of the hardest things to do in franchising, certainly in service franchising, is to raise prices because you have
100%. Yeah.
personal relationships and memberships. What private equity is really good about is doing the investment in research to
Yep.
defend a thesis around price. And it makes it a lot easier for franchisees to get their heads around.
And they're sophisticated enough to do the sensitivity analysis on it, right? In terms of, like, we may raise price 30%, we may lose 10% of our customers, but we're still net 20% positive, right? And I think that's something I've not seen very many franchise brands even consider, when they're on their own or emerging. That, for a PE firm, it's like the first order of operation is like, let's run a sensitivity analysis, see what we can get out of it, right?
Yeah. Well, and
Yeah.
there is a trust factor in there with that though. And I think
Yeah.
it's sort of a double-edged sword there. So the private equity firms that do it well and that work with the leadership teams to roll out that communication around it, generally get better results.
Yeah.
Sometimes you can have all the data in the world.
Sure.
And so you probably saw Kat Cole's talk at the IFA
Hmm.
conference,
Hmm.
where
Hmm.
she talked about how, despite all the data, the franchisees said they were going to sue the franchisor if they had to sell a bigger or a smaller cinnamon roll,
Yep.
even though that's what the consumer wanted and all the vision.
Right.
And I think the same thing can happen with pricing. You can have all the data in the world, but if you
Yeah.
don't have a leadership team in place that knows how to engage the franchise system and build trust,
Yeah.
it still can be fraught trying to
I
roll out.
mean, I think a lot of quick service restaurants are experiencing that today, where
Yeah.
the is there value in the value menu question is very pertinent to kind of consumers right now.
Yeah, yeah, and you see this bifurcation of the economy right now that I think makes it
Hmm.
challenging too. And you're trying to serve all customers, but in reality, there are customers that are specific to brands where they're going to have different economic considerations than in other brands where you're dealing
Yeah.
more with the American royalty type of franchise or type of consumer. And
Yeah.
the franchisee really gets that sometimes who their customer really is. And I think it's important for the PE firms, even with all the data in the world, to be able to really listen to the field and understand what's happening at the unit level.
Yeah, I totally agree. And you've touched on this a little bit, but with private equity, kind of having the pockets to be able to invest in more technology or to invest in workflows and automations, how much of that do you think private equity will start bringing in house? Right, like they're kind of rolling up, they're building the platforms around a bunch of service brands. Do you think there's a world where they start building their own operating system technologies and say, hey, if you're a service based franchise, we've kind of built best in class by acquiring these four, five, six things and putting it in to operate kind of uniquely by themselves.
That's a really interesting question, Paul, because certainly the platforming trend is huge.
Yeah,
And I
that's undeniable. Yeah,
Yeah, and in food services, it's relatively sophisticated, and I think some of those services probably are better developed to be able to
yeah,
deliver across multiple brands.
yeah,
In service, it's a little more challenging, and what I've seen with this is oftentimes the question that has come up. I mean, in every brand I've been in, we've done a build, fix, or buy exercise around
sure.
technology.
Yeah,
Do
yeah,
we build our own? Do we
yeah,
buy something off the shelf that everybody else can buy? Or do we just fix what we have? Do we just put
yeah,
band-aids on it and leave it for the next round? And I think it's a tough, tough question. The hard part for private equity in this is that they don't really want generally to be founders of something. They don't want to
sure.
be to launch a product because they have a very specific time window, generally around 5 years.
Yep.
And you don't get the economic benefits from it if you spend 2 years developing it, a year rolling it out, and it's only showing up in year four when you're already hiring a banker.
Yeah,
So it's a
exactly.
little tough for that. But that said, what I'm seeing increasingly is that certainly in that second turn of equity,
Yeah,
when you've got a more sophisticated firm coming in, they will look at that question a little differently because they may have something already where the
yeah.
work is done and they know what needs to happen.
Yeah, I would
But
imagine like the margin analysis changes at that point as well because the initial equity is looking to make a much different multiple in those first 5 years than the second class of equity is looking to make. And so for them, if they can build and reduce technology margin by or increase margin by 20% on the technology spend alone, it's probably more worth it in that second pass than it might be in that first pass.
yeah. You know what's interesting to me though is so often it's these bright, shiny ideas that get so
Yeah,
much attention in the boardroom. But at the end of the day, when you really think about what franchising is and who the customer actually is, it's that
yeah,
franchise. And
100%.
it's the investments in things like how do we support our new franchisees to have faster ramp? Because
Yep,
we know typically there's a hockey stick followed by, a slower growth that looks more like a table, right? But
yeah.
it goes up incrementally. And if they don't master that same hockey stick at the beginning, it wherever that table is, that's where it
It
lands after
plateaus them. Yeah,
12.
yeah, yeah.
So investing in the resources and personnel and training systems to be able to get those franchise, even marketing, putting that money towards marketing to
Yeah,
get them up that ramp and get them to a higher level is actually going to pay more dividends in the back end because it's
yeah,
more difficult. Same thing with like innovation. Oftentimes they're looking at the product lines, like could we introduce products into a service model that are going to add a whole new revenue stream?
hmm,
Yes, but is that really going to buy you as many dividends as doing the work around
sure.
adjusting pricing or doing the work around support and helping the
Yeah,
the lower performers to become higher performers or to exit even and getting those
yeah.
bigger then? So it's an interesting thing seeing that because it comes up again and again. Like with every brand I've worked with, there are questions around the e-commerce angle, and
Sure.
it's not always the right thesis. It
Yeah.
because you're, I mean, you may make money, you may not. It's got some risk associated with it, and I think that's where private equity does think in terms of 5 years. There's
Yeah.
a different
Yeah.
perspective on that risk timeline.
Yeah, no, it is fascinating. I think that point resonates so much with us. Like we are an AI technology company, right?
Yeah,
Flamel is. And so I think we have been a part of the hype curve a little bit. I think what we've done is everything we've transitioned into talking about is workflow. It's workflow, it's workflow, it's workflow, right? It's like, hey, we make this easier, we reduce the time here, we get that result faster. It's all this like interstitial stuff that is hard. And it's not just saying like, oh, look at this cool, sexy new AI thing we've built, like, which is what we have done. But then you got to like really put it into those words that, to your point, any given franchisee can understand, grasp, and like leverage for their own growth, because that's all that matters at the end of the day.
that's it. Like they have to understand how it's going to benefit them. And I
Yeah.
think, where I see franchising and private equity sort of coming together right now,
Hmm.
it's almost like so much of the world has moved into this sort of technical digital space.
Yeah.
But the interesting sectors right now are the analog sectors, the
Uh,
sectors in service.
you've perfectly transitioned us, because that's what I was going to ask you next. Is
Oh,
service-based businesses are all the rage in private equity right now. They
yeah.
have been for the last probably decade plus. And I would agree with you. I think it's one of those things where a lot of private equity firms are seeing the future a little bit. They're seeing that digitally based things, like there's going to be a lot of job loss and job replacement happening there. But the things that can't be digitally replaced are, cleaning somebody's house, are taking care of their pet. What have been the driving factors for that? I would argue AI has been one of those, but what else would you add that has really like forced private equity to have better focus on that industry?
I think there are a few things. I think what's happened in the service sector is that historically it was a much more fragmented sector. So there hasn't been so
Sure.
much.
Two guys
Aggr-
in a truck all
yeah,
over the city. Yeah.
yeah, and so there's all these aggregations plays to look at
Hmm.
and
Hmm.
to think about, how do you take a business that has historically been all mom and pops
Yeah.
and brand grow up within it that can take market share because it's a brand, because it's doing
Yeah.
something different. But I think the other area that they're real interested in is anything that has sort of that real lifestyle consumer focus right now is really intriguing to them.
Yeah.
I think it's because of that idea that you can't be digitized. It can't happen. So you think about, pet care. You can't really digitize that experience.
Sure.
It's not going to
Yeah.
happen.
Spot
You
has to go somewhere physically.
That's it. Yeah. Treat it
Yeah.
that way, personal care. So even if they do, I mean, I've seen the things where they've got the robot that cuts hair now. That's
Sure.
great, but nobody wants that. Your hairstylist
Right.
is your therapist. Like you want to
Hmm.
go to a human being. And the same thing when you think about elder care or kids' education and enrichment. It's like there's all
Empathy based businesses is what I call it. If there's any form of the process that involves empathy, be that sitting in the chair talking to the barber, or like
yeah,
trusting this person with my dog that I treat as my child,
yeah.
anything empathy based, I think is very investable by PE right now.
Well, and the other big trend, I think it kept coming up at IFA is this whole notion of the sandwich generation.
Sure.
So
Yeah.
for those of us in our demographic that have, oh, my demographic, I think I'm a little ahead of you, that have elder parents, so aging
Hmm.
parents, along with children. So my
Yeah.
mother passed away from Alzheimer's a couple years ago, and I went through that whole journey. But I also have
Yeah.
an 11-year-old daughter,
Yeah.
and I think what private equity sees is that consumers in that sandwich generation are also among the most economically fortified and stable,
Sure.
and they have the disposable income to spend. And where are they spending it? Well, they're investing in their own longevity through all these,
Yeah.
wellness services, but they're also investing in services for either end of that spectrum. It's
Hmm.
funny. So being a part of the Scenthound board now, fascinating. So it sort of brings all of that together
Yeah.
around pets because you've got sort of the longevity thing going on with pets where it's
A
not,
hundred percent. Yeah.
yeah, it's different. It's not just, straight up services in beauty anymore. What people want is wellness. And even with dogs, what they're looking for, like with Scenthound, is something around hygiene and longevity for their dogs. So
Yeah.
these really innovative service factors that really can't be digitized, I think are kind of fascinating right now.
So I had Tim on this show maybe a couple months ago, and it was
Oh,
one
that,
of the things we dove really deep into, which was the longitudinal data that they collect on pets and animals is very unique,
yes.
exceptionally unique. And
Yep.
I think um, I have my opinions based on where they're taking that and what they're going to do with it, and I think it's probably what makes them exceptionally interesting to PE funds. It's that they've got a great solid operating business, but then they have this data component that allows you to think of like a 2.0 3.0 lines of business on top of Scenthound and what you can really produce outside of it that just have to be fascinating.
Oh yeah, well, and thinking about that sort of where digital comes into that is still a hugely important factor.
Yeah.
And even for human longevity, we all have the digital. I'm old school now. I thought
Yeah.
new school, but I'm old school now. But everyone's got their ring or their watch
Not
or
worrying. Yeah.
some tracking device, or they're a membership of something like Fun. There's all these trends sort of towards the digital aspect of measuring it.
Hmm.
But ultimately, there's just, I think, a real win if you can find a business that hasn't lost that analog human component.
Yeah. No, 100%. I think I'm trying to think. Like one of the first things I asked Tim was, so when do you become a pet insurance company, and when do you become like a pet
Yeah,
prescription provider? Because you're gonna have all this like perfect healthcare data around like, hey, the coat was shiny this time, it was less shiny next time, or like you see all these health data points that they have, and to your point, you mix health data points with just a functional physical business that works. Like
yeah.
it's something special. They've been able to like combine both worlds, I would say.
Yeah, you know what's cool about that too is I think it's sort of a parallel to franchising generally, because I
Yeah.
think where historically, investors like private equity were
Hmm.
looking at businesses that you could sit in a boardroom and look at spreadsheets and really understand that and have command and control, and thou shalt. We're changing the marketing program to this. We're changing the
Yep.
pricing program to that. And we're going to run this thesis. Getting into franchising, it is similar in that analog piece because you have such a human component to it with the
Somebody
franchise.
has to functionally go do the thing.
Yes, and
Yeah.
that somebody is on the ground. That somebody
Yeah.
is a true entrepreneur that's out there in the
Hmm.
local market. I took my daughter to her franchise brand, Sylvan,
Oh yeah,
Learning
sure.
Center for her math tutoring the other day.
Hmm.
And as we were driving, she was looking at the fence of the football field for the high school.
Hmm.
And on the fence are all the banners of the sponsors that have
Is
come
it
in.
like all local
It,
franchises?
it 100%. There was
Yeah.
non-franchise business. It was like 15 banners, and there wasn't a single one that wasn't a franchise.
I would believe it. Yeah.
And that's the piece where you realize like franchise means local, like the IFA says, but I think that's the piece is it's local, but it's real. It's a real
Yeah.
human being that really made an investment and really started a business. And I think that's it's fascinating to me, this nexus of this large institutional capital coming in that looks at the world through a completely different lens. It's sort of like what is the little apex of the triangle.
Yep.
And
Yep.
they're looking up to these big institutional investors. Meanwhile, here's the leadership team looking at the big pyramid that's based on all of these individual owner operators coming in.
Yeah.
And the
That
PE
is.
firms that win are the ones that get that. They
Yeah.
understand.
I love that visual, and I think it makes for a great question. So we've talked a lot about like how brands change or how they need to operate to then get involved with private equity and kind of what
Mm,
that looks like. I think it begs the question of what happens after private equity, right? So
yeah.
the last company I helped build, we got acquired by private equity. A lot of things changed after that. And then kind of reframing it from your question, I love that because you are then the focal point as the franchisor because you have PE up here, you have the Z's down here, and all the pressure and intensity is focused down on you as the Zor. What does that look like and feel like on the Zor side? And how do you see operations typically changing once that comes into play?
Yeah, it's an interesting thing. I've lived most of my career in that little point, and I
You
actually.
like high stress situations, yeah?
Yeah, but what I love about it is that you've got people that really get excited about a business and want to bring money to bear where
Yeah.
money hasn't been available, want to bring expertise to bear where it
Hmm.
may
Hmm.
be, well timed. And then you have folks at the bottom that are looking to you in that space to say, "Tell me everything's going to be okay." And it's hard because you don't have all the control.
Because you
But
also
what
don't
I
all the way know, yeah.
Yeah. But what I will say, there's a couple of things that change. One of them is really discipline.
Yeah.
So they'll call it professionalizing, but I would actually call it discipline. So
It's
what
rigor, yeah.
happens with that is that all of a sudden every decision is going to be based very heavily in data. You're not going to make any
Yeah.
decisions on guts. So often that's how these brands got to where they were. It's
100%. Yeah.
so I'm always the first to admit I'm not a Jobs. When I look at founders and I see what founders do, I'm always impressed. I'm Wozniak. Nobody knows who
Sure.
Wozniak is. Look it up. He's the guy in the back that figures out how to turn that into a system or process
Yeah.
and execute it. And
Yep.
so you have, this influx of capital and they want to do the rigor around that. But then for me, what has changed in that space, I've often walked in after a founder or a prior CEO has left.
Yeah.
And why that happens is because they haven't been able to get into pace with that
Yeah.
private equity firm because the pace changes dramatically.
Yeah.
And that's true at every level. It doesn't matter if this is the first turn with private equity or the third turn, fourth turn with
Yeah.
private. That new firm is going to have its own personality and its own pace. The same rigor, that same, discipline, but the pace will change. And I
Yeah.
think that's the part that makes it really stressful and really hard is trying to figure that out. And
Yeah.
yeah, so often that what turns out is that there does need to be change in leadership teams. Oftentimes
Yeah.
CEOs will select out, oftentimes the private equity firms will select out because they need people that can come into pace with them. But where they win is when they understand ultimately that they bought the brand, but it is not the brand that creates
Yeah.
value.
It's all the
It's
people.
it's the people, it's the
Yeah.
franchisees, it's the team. And so if they understand that and they understand that it is fundamentally a trust-based business, they will get it and understand that even if they have to make changes, they need to do that with dignity and they need to do that with thoughtfulness about how that's going to be perceived.
Yeah.
Because even if it's the right thing to do, the franchisees, they need to understand it because if they don't trust who's sitting in the seats, you're going to get a lot of resistance
Sure.
to any change you try to implement. And so I think that is the sort of it's the moment of highest risk. And in fact, there was a really great article written back in 2023 about this. It was
Mhm.
called something along the lines of "Private Equity Needs a New Talent Strategy," I think was the title of
Oh,
it.
interesting.
And it was in Harvard Business Review. And what it talked about was this very problem and how so often in a 5-year thesis, a private equity firm will have to add 2 years to it because of the changes
Because
that
of
they decide.
executive turnover. Yeah.
And that
Yeah.
turnover at the beginning will actually add time to that thesis, and time for them is money, time for them is everything. And so
Yeah.
I think in franchising, they understand that better than they did 10 years ago, for sure. And so you see
Yeah.
sort of a different dynamic with that in most firms than you did 10 years ago.
Yeah, 100%. I think you really call out a great point, and I talk about it a lot myself, and it's this idea that you are not always the best leader for your business at every stage of that business, and
Absolutely.
oftentimes what took you from 0 to 1 will not take you to 1 to 100. How much of that coaching work do you do with franchisors before they go start talking to private equity? That is like almost just being real, right? It's basically saying like, "Hey, are you ready for your job to be this instead of that?" How much of that conversations do you? How many of those conversations are you typically having with people? You know.
I do have those conversations. I've had some of that with both the private equity firms and with the
Hmm.
firms themselves during the acquisition process. But beyond that, it happens so much peer to peer at IFA.
Yeah, 100%.
And I've had so many conversations with other CEOs when I've gone through transitions because
Hmm.
most of my transitions, well, all of my transitions really have been related to transactions.
Sure.
And you talk to other folks who've been through transactions and they have their versions of stories to tell.
Hmm.
And I think the best message that I think all of us understand is it sometimes feels very personal to the franchisees, to the
Yeah.
teams, but it's not really personal.
Sure.
It's
Yeah.
really it's people trying to make the best decision to support the stakeholders that they can in that moment. And
Yeah.
the top of that triangle, when they're feeling that time pressure from their investors, it's forcing them sometimes to have to make their best guess about what's going to be in the best interest of everybody involved in the time frame that
Yeah.
they have. So, but so much of it is peer to peer today. We've talked about that at IFA of needing more
Hmm.
structured groups for CEOs to really learn from one another in it because my heart is always at the end of the day with the franchisee. That's where I started my journey. I was a
Yeah.
franchisee at the start with Curves,
Yeah.
not knowing what I was doing,
Sure.
counting on the corporate world to tell me how does this work. And going back and getting my MBA was eye opening to me. And it's all the things
Yeah.
I wish I had known before I started
Sure.
my franchise, right? But so much of that I think the IFA does a great job with. But I don't think there's anybody who can prepare you for all of the nuances of that.
Yeah, no, I think it makes a ton of sense, and I'm curious, kind of as a last question to get into here with you, I really want to talk about the future of private equity's impact on
Yeah.
franchising because I think, you know, At some point, especially in like a very volatile economy like we're kind of entering into these days, private equity changes its mind on some things. They start operating a little differently. They pull the purse strings a little tighter, maybe. How do you see PE playing out over the next 5 to 10 years within franchising, maybe specifically to the service industry?
Yeah, the service industry is the one I know the best, Paul. I mean, it's
Yeah,
where I've lived my entire career, somewhat intentionally. But I
yeah,
will say I don't see any lack of interest on the part of private equity. I was a little worried as, things started to get kind of wonky with the economy
sure.
that you would see, something changing. And I think there is a lot more caution going on right now.
Hmm.
But I think the interest in the sectors that I'm seeing hasn't changed because they know that that's where the economic opportunity is going to go.
Yeah,
This economically fortified consumer who can afford to invest in his or herself is going to be spending that money somewhere. And so private
yeah,
equity is always going to raise their hand to try to figure out how to get in that value chain. What I do see is an increased interest in platforming, for
yeah.
good or for ill. And you see more and more of that, particularly with the second turn of equity. The first turn of equity generally is just looking to strengthen the brand, fortify it, and
Hmm.
get it ready for that next stage. But I think many franchise brands, particularly in the service sector, will end up selling into platforms.
Yeah.
And we don't know what that's going to look like. The other thing I've seen with private equity, and I find this really interesting, is that there is an increasing interest in becoming franchisees.
Well, awesome. Again, Christina, thank you so much for joining us. And for everybody else, I hope you guys enjoyed this episode as much as I did. I think undeniable forces at play. If you don't learn about how private equity is influencing franchising today, you're missing out. It is going to be hyper influential and it will continue to be. So thank you again, everybody. And thank you again, Christina. And we hope you guys join us on the next one. We'll talk to you later.